Today we're covering a fun or not so fun topic, which is 5 red flags that can trigger an IRS audit. We'll go over some common missteps that can cause the IRS to take a second look. And trust me, it's a lot easier just to avoid these traps than to deal with an audit, although it's not the end of the world. Hey, my name is Mark too, and I'm a CPA and former reseller who specializes in helping resellers and online business owners with taxes and with growing their businesses profitably. And let me start off by saying an audit is not the worst thing in the world, especially if you have your records in order with proper documentation. And usually when you get an IRS letter, it's not even for an audit. Usually they just automatically calculate the additional tax they think you owe and send you a bill. And then it's on you to show them why you don't owe it, if you actually don't owe it. And an actual audit is a more formal process usually conducted by mail. So let's dive in. Red flag number 1 is excessive business meal expenses. Now, this isn't necessarily the top red flag, but meals is a very common expense among my reseller clients. When you're out on the road sourcing, it's common to stop to grab a bite to eat. While meals can be a valid deduction if they're directly related to the business, the IRS keeps a close eye on these because typically in-town meals on your own are not deductible. The meal needs to be part of either out-of-town business travel or part of a business meeting. So just stopping at Chipotle between garage sales doesn't qualify. And if you're claiming frequent high-cost meals, it might look like you're using your business account to cover personal dining. So here's how to keep this deduction in the clear. Only deduct meals that are truly business-related, like a client or partner lunch, or any meals when you go to your reseller or other business conferences. For each meal deduction, record the who, what, where, when, and why, and that way if you're ever asked, you have a clear record showing the business purpose. By keeping meal deductions modest and documenting well, you can avoid this red flag and ensure you're taking this deduction within the rules. So here's one that trips a lot of people up. Consistently reporting excessive losses. If you're reporting a business loss for several years straight, the IRS might wonder if it's a business or just an expensive hobby. So here's what you need to know. If the last 3 or more out of 5 years shows a loss, the IRS can in theory classify your business as a hobby. And while that might not sound bad, that actually means you lose out on a bunch of deductions which will increase your tax. But don't let that stop you from claiming those losses if they're legitimate. It's not difficult to show that you are indeed a business if they ever question it. Running a business can be tough and losses do happen even for years and years in a row, but proving you're serious about profit can help keep the IRS away. The next one is large or unusual deductions. If you're a sole proprietor suddenly writing off a private jet, the IRS might take a closer look at something like that. Even with smaller things like entertainment or travel expenses, unusual deductions can raise eyebrows if they're out of sync with the kind of business you run. So to avoid this, make sure every deduction is ordinary and necessary for your business. This means that it should be a common expense for businesses like yours. Avoid going overboard on meals and entertainment, even if they're related to business. The bottom line, if it looks extravagant, keep detailed records and be prepared to explain why it was needed, and that's only if they ask. If you have a half-decent reason or documentation, that should be the end of it. Now let's talk about the home office deduction. Contrary to popular belief, the home office deduction itself is not a red flag. The abuse of the home office deduction can be a red flag. If I claim 98% of my home as a home office, that'll raise more eyebrows than if I claimed 20%. But then again, if you truly exclusively use 98% of your home for your business, then you'd have nothing to fear about an audit. The IRS is wary of people claiming home office space that doesn't actually meet the criteria. But if you do meet the criteria, then you're fine. Your home office needs to be used exclusively for business and it has to be your primary place of business. No double dipping with your kitchen or man cave. So keep it reasonable. If you're working out of a tiny corner desk, don't claim your entire basement. Done right, this deduction is totally legitimate, and you can include any inventory space too. Just make sure you're using it correctly. And next is not reporting all your income. This happens a lot with resellers and online businesses who get paid across multiple platforms. If you have income from eBay, Etsy, Amazon, Shopify, it can be easy to miss something, but the IRS receives income reports from those platforms too. And to avoid a costly mistake, you want to double check your records with all income sources. If they sent you a 1099 or if you received income, it needs to be reported. For non-1099 income like cash sales or payments from smaller platforms, you still need to keep records and report these too, even if it's small. The IRS loves finding unreported income, so don't give them the satisfaction. Being thorough here can save you from a huge headache later on. So there you have it, 5 top audit red flags to watch out for. Excessive business meal expenses, reporting excessive losses year after year, unusual or large deductions, over-the-top home office claims, missing or underreported income. So if you stay clear of these, your chances of an audit will decrease. And remember, keeping accurate records and being consistent goes a long way. If you have any questions, post them below or come post them in my free Accounting for Online Sellers Facebook group. Subscribe and check out the links below for more resources to help you optimize your tax situation and overcome the anxiety so you can focus on building your business profitably.